Hi there, and welcome to Clarkenomics. In this video, we're going to talk about some different types of credit. In a previous video, I made about credit cards. We talked about how to use those, but in this, we're going to talk about some other forms of credit that you'll likely experience in your life. Because a lot of times students ask, when will I use this? Why does this matter? And for credit, it matters because unless you're super rich, you're probably going to need credit at various points in your life, right? Maybe you want to buy a car. If you don't have the cash to pay for the whole thing, you're going to have to borrow some money. Maybe you want to go to college. College is tremendously expensive, unfortunately. Probably need to borrow some money. And you want to buy a house. Almost nobody buys a house with cash outright, so you're going to need to borrow some money. And so most people will find themselves having to borrow money, and this can either be relatively expensive or not, right? But you want to make sure that your choices are not unnecessarily expensive. And there's some good ways to make sure you're minimizing your costs, and you want to be careful. Just a disclaimer though, this is a basic overview of different types of credit. Always do thorough research of your own, right? So this is just an introduction to borrowing. So let's start off with the one a lot of young people will probably experience first in their life, an auto loan, a car loan. Most auto loans these days are fixed rate loans. What does that mean? What does the fixed part mean? Well, the fixed part means that the interest rate will not change over the life of your loan. So you are locking in an interest rate. So if I get a loan with like a 2.5% interest rate over the entire life of the loan, over the entire term of the loan, that's the interest rate that I'll pay. It will never go up and it will never go down. If you get an interest rate that you think is too high and now market interest rates are lower and you think you can get a better one, you do have the option of sometimes refinancing. To refinance means to replace one loan with a new loan. So essentially, if you don't like the terms of your loan, you can talk to another bank and you can refinance your auto loan. Be careful though, because there are costs associated with doing so. Now, the interest rate, like most interest rates that you're going to pay, is going to depend on your credit score. So if you have a high credit score, typically your interest rates will be lower. If you have a low credit score, your interest rates will be higher. And remember, you are the borrower, so you are paying interest. High rates are bad, low rates are good. So the term for an auto loan can vary. It's a pretty wide range, actually. Some of the shortest terms for an auto loan are 24 months, which is 2 years, all the way up to a whopping 84 months, which is a 7-year auto loan. It's a very long time. Most commonly, most people these days get a 60-month term for their auto loan, which is 5 years, although the 72-month loan, which is a 6-year loan, is increasing in frequency. On average, the term is 65 months, and it is rising. So people are taking longer and longer to pay off their auto loans. And we'll talk about why that's good and why that's bad. So let's say you opt for a longer term, as a lot of young people typically do because their income is lower. They don't make very much money, so they might opt for a longer auto loan term. Well, why do they do that? They do that because if you stretch out a loan over a longer period of time, it means you owe less money every month when you have to pay this. So your monthly payment's going to be lower, and if you're a young person and your income's not very high, that lower monthly payment is going to be very attractive to you because, okay, well, I don't want to pay $400 a month for my car. I'd rather pay like $200 a month for my car. I can afford that. But you have to be careful because essentially, the longer the life of the loan, typically speaking, the higher the interest rate will be. And what that's going to do, especially if you're taking longer to pay off the loan, is it's going to make the total cost of the car greater, right? Because the car doesn't just cost the sticker price, the car costs whatever the sticker price is, plus whatever interest you're going to pay, plus whatever maintenance you're going to have to put into the thing. You got to consider the interest, right? So a $20,000 car, once you factor in the interest, might be a $25,000 car or even a $30,000 car. So the longer the term, the more money overall you're going to pay for the car. Even though the monthly payment might be lower, which sounds like a good thing, that car is going to be more expensive for you when you have a longer term. Shorter term is just the opposite. Because you have less time to pay off the entire loan, it means you have to pay more every month to accomplish that, right? So the monthly payment is going to be much higher for a shorter term, but the interest rate's typically going to be lower, and the total cost of the car will be lesser. Again, young people don't typically opt for this because that higher monthly payment scares them away because their income, sometimes is either low or it's unreliable, right? If you're a server in a restaurant, it might be inconsistent. So again, there's no right or wrong here, but you just have to consider all of the factors when making your decision. So, buying a car, be careful. Watch out for this hidden cost called Depreciation. Depreciation is just a general economic term for when a thing that has value loses its value, right? So anytime a thing is losing its value, we call that depreciation. And cars depreciate a lot. Why? Well, because there's a few reasons, right? Cars are something that have a lot of moving parts. There's a lot of wear and tear when you drive them. They'll need maintenance. They're going to lose their value. Not only that, new cars come out every single year, right? The model year is every single year. So if you buy a 2015 model, when the 2016 model comes out, people are going to want the most recent model, and that older model is not going to be as valuable to people. So you won't feel your car depreciating, but you'll notice depreciation when you go to sell your car that you own. Because when you sell it, you're going to hope to get a high price for that car. But if it's depreciated, you're not going to get very much money for your now used car. Now, depreciation is unavoidable pretty much, unless your car has now become a classic car and those start to appreciate, which means gain value. All cars depreciate, but the rate at which they do so differs and is important. One of the fastest ways for your car to lose value is if you buy a new car, right? If you buy a brand new car, no one's ever owned it before you, right off the lot, it's going to depreciate fairly quickly. And that depreciation begins from the second you drive it off the lot, because now it's yours. It's not a new car anymore. It's instantly used when you drive it off the lot, even if you only own it for a day or for a week or something like that. So there's a graphic I found from NerdWallet, which is how much will my new car be worth in 5 years. Let's say you spend $25,000 on a car today. A year from now, that car will be on average worth about $18,750. What that means is that car is losing over $6,000 in value within 1 year. And again, you're going to feel that when you go to sell the thing. By the end of 5 years, that car is only going to be worth $9,112. So new cars depreciate. If you were to buy a car that's used, it's still going to depreciate, but you're going to miss that initial hit in depreciation that new cars often take. So make sure you are researching different cars, different models before you're buying them. Some cars depreciate faster than others, depending on like even what automaker it is. Hondas, for instance, are known for having good resale value, meaning they don't depreciate necessarily as much as maybe some other car manufacturers. And so you can find all of this publicly. Kelley Blue Book is a great resource, kbb.com, great resource for looking at different car models. Make sure you shop around and consider all these things before you buy a car. Don't be impulsive because, again, we looked at the term lengths in the previous slide. You might be stuck with this car for 5 years, 6 years, 7 years, right? It can be a very long time. So you want to make sure that you're not upside down. This is a financial term for an auto loan where you owe more money on a car loan than the car itself is worth. It's a bad situation. What that means is if you were to sell the car today, you would still owe money for a car that you no longer even own, right? And again, the longer the life of the loan, the more in danger you are of finding yourself upside down. Because again, let's say this is you over here, 5 years, you still owe, sorry, this is how much your car is worth. But let's say because you took a longer term loan, you're not making high monthly payments, you're not paying down the principal you owe very much. Let's say you still owe $12,000 on this car loan. Well, if the car is only worth $9,000 and you owe $12,000, that means you would still owe about $3,000 if you sold the car. And you don't even own the car, but you'd still owe money on the car. So again, be very careful, think about all these factors before you buy. All right, how to get an auto loan. Where can you go? Well, a lot of times people just go to the dealership. When they go to the dealer, they buy the car, the dealer says, hey, would you like to do financing through us? And people say, sure, because it's easy, right? You're at the car dealership anyway. You apply for credit as part of the buying process. You don't have to take any extra steps. It's a one-stop shop, pretty easy. But you might not be getting the best deal because you don't get to shop around to different lenders to get the lowest interest rate. So again, there's perks and there's drawbacks to all of these different things. Some of the bigger car makers like Ford, General Motors, they offer credit through themselves. So that can be a good way to finance a car. Again, that can also be done sometimes at the dealership as well. It depends on what kind of car you're getting. Banks. Before you go to buy a car, you can get pre-approved for a loan. So you'll enter information about yourself and your income and your credit score, and they'll say, okay, we'll approve you to borrow up to, let's say, $30,000 for a new car. You go to the car dealership with that loan in hand. You're already pre-approved for that loan, and you buy a car that costs less than that limit. And so that's a good way sometimes to do some shopping before you actually go buy the car to make sure you're getting the best interest rate possible. Um, but again, it's still from a bank, right? So banks are still for-profit entities. If you would like to maybe even get a lower interest rate, you can go to a credit union. A credit union is a little bit like a bank, but it's a nonprofit organization typically. So it's owned by its members essentially, rather than like shareholders in the traditional sense of like a bank. So they might offer you lower interest, and just like with a bank, you can get pre-approved for a loan before you go to the dealership. So you don't have to sit there at a desk and kind of have a take it or leave it situation. You've already done your research, you've done your shopping for a good loan. So credit unions can often be a very good way to go when buying a car. Again, look online. They all have websites, and they all mostly publish their interest rates, and you can inquire a lot. It might be a little extra work, but think about how much money you could possibly save when you're talking about a $20,000, $25,000, $30,000 car. An interest rate being just even like, 1% lower can give you massive savings. Now, one thing, a lot of car commercials these days offer interest rates in the commercial, right? So they'll say 0% interest for this long. Those promotions, there are some limitations on them if you read the fine print. One, it might not be for any car, it might be for certain models that they're trying to move. But two, the only people who get those deals actually are people with the best credit scores. So if you don't have stellar credit, you're not going to get those primo interest rates. So you have to make sure your credit stays good, and you'll learn about how to do that in another video. So that's just a bit about car loans. Let's move on to student loans. College is one of the most expensive choices of your life. Make sure you choose wisely. Unfortunately, it's a decision you have to make at a relatively young age, and it's going to stick with you for a very long time. So, talk to every wise person you know about what to do here because, again, there's not really do overs so much. So, consider options that most people don't always consider, like community college, technical school. Sometimes these things can offer a good education at tremendous savings. And when you're shopping around, you're looking at colleges are making you offers. Don't just look at the sticker price, like the advertised price of tuition. You have to consider a few different things, right? You have to consider the aid offered by the school. Maybe this college is, 100 grand per year, but they're offering me 70 grand per year. What's the real cost of going there per year? But it's not just like the tuition cost. There's other costs too, right? What's the cost of living at school? Whether it's the dorms, what kind of amenities do they offer? How expensive are they? Or even if you're living off campus, what is the cost of living in this place, right? So if you want to go to school in New York City, even if you're living off campus at a school like NYU, cost of living in New York City is very expensive. So you have to factor all of this in when you're making your college decisions. If you are somebody who travels home a lot, right, for Thanksgiving or other holidays like that, does it cost a lot to travel home? So if you want to go out, if you live in Delaware, you're from Delaware, and you want to go out to college in California, that's about 400, 500 bucks every time you want to go back and forth. So you have to factor that in as well. Moving costs, if you want to move your stuff out there, there's a lot to consider. Not to stress you out, but make these decisions in an informed way. Don't just jump and say, well, it's always been my dream to go to this college. That's fine, but consider these things. Choose wisely because this is a big decision. Now, to get student aid, you're going to encounter something called the FAFSA. Your parents will probably take the lead on this, but it's good to be involved in the process as well. This acronym stands for the Federal Application for Federal Student Aid. I think actually it's free application for federal student aid. I got to double check on that. But in any case, what this form is supposed to do is supposed to evaluate your family's finances, how much money they make, what are their debt obligations to see how much you qualify for loans, grants, other aid, scholarships, things like that, right? So that's going to be your ticket to a lot of um, loans and stuff like that that you need to go to college. Now, just because you fill that out doesn't mean you can't apply for other scholarships. You should look for opportunities out there because there's a lot of scholarships out there for all kinds of different things. Different organizations are always offering these things. Businesses, same. But one important rule is never put up money to get a scholarship. In other words, applying for a scholarship should be free. There's a lot of scams out there as well. So if they're asking you to pay money to apply for a scholarship, look very carefully at it and see if it's legit. Most people get federal loans when they go to college, they apply for college, often because they offer better terms, better interest rates than private loans being through companies. So if you're looking into private loans, be careful. They might not offer some of the same benefits as federal loans in terms of like loan forgiveness programs or things like that. Private loans, you know, your hands your fate is in the hands of a company rather than the government. And the government's job is to look out for you. A private company's job is to make money from you. So just again, consider all these things, be careful. Everyone's personal financial situation is different, but you have to consider these factors. So that's a little bit about student loans. Eventually, you will possibly want to buy a house, right? You might be a renter for life, and that's obviously fine, but some people want to buy a house. If you're going to buy a house, most people are going to need a loan to get that. And that's all a mortgage is, if you've ever heard that term. It's just a house loan, right? We just call it a mortgage. And here's kind of like the process for doing it. You're going to need to get pre-approved by a lender, typically a bank, but that's not the only place you can get a mortgage. And they're going to look at your financial situation and they're going to tell you, okay, you could buy a house that costs up to this much money. We're going to approve you for this much credit. So you're going to need good credit to buy a house, and you're going to need proof of income. You're going to need to prove that you earn money and that when that first mortgage payment's due, you're going to have the income to pay it. That's very, very important because banks only want to loan money to people who are likely to pay it back to them. Once you've been pre-approved, you're going to want to find your next house or find your first house. There's a lot of things to consider, but just some basic things to consider here are how long are you planning to live there, right? Will your career take you to another city and you'll have to sell your house soon after you buy it? That's how some people lose money on their home. So, you have to consider how long do you see yourself there. Not everything is predictable, but this is where planning comes in handy. What's your monthly income? They're going to give you an estimated mortgage payment, how much you're going to owe for your house every month. And you have to look at how much money you make every month. Because again, if you don't pay your mortgage, this is secured debt. So if you don't pay it for long enough, they will take your house from you because your house is collateral here. And so consider the price of the house. How much is your down payment going to be, right? So when you buy a house, you can't just go in with no money. You have to put down some money on the house first. These days, you don't have to put down a lot, but the more you put down as a down payment, the less you're going to have to borrow, which means you're going to owe less interest. So consider these things as well. Most commonly, people get what's called a 30-year fixed mortgage. This means that the term of the mortgage is 30 years, and it's a fixed rate loan, which means the interest rate will not change over time. Um, if you want to refinance, just like with an auto loan, you can if conditions are right. Again, refinancing does cost money, but if you're staying in the house long enough, it can certainly be worth it. Do your research. Why do people own a house? Well, some people like owning things, but otherwise, owning a house can be a great way to build equity. What that means is you own something that is valuable, right? So, if you have a $300,000 house and you've paid off $100,000 of that house, you own $100,000 of equity in that house essentially. So it's a thing you can put your money into, which will hopefully gain value. Houses are not guaranteed to appreciate. Sometimes houses can depreciate. This happened a lot in 2007 with the housing crisis. When you owe more money on a mortgage than the house itself is worth, there's a slightly different term for that. It's called being underwater. So that's a situation you want to avoid where you owe more money on a house than the house is worth, which means if you sold the house, you would still owe money on that house. Most people then would just choose to stay in the house, but then you feel like you're trapped in that house and you can't move. So not a good situation. Now, when you own a house and you have a mortgage, essentially you're going to have a monthly mortgage statement. They're going to send you, you can call it a bill for the house essentially. Because even though you are the owner of the house, you borrowed money to buy that house and that house is collateral. So you owe the bank money for that house. So they're going to send you a statement every month with a bunch of pieces of information. First, they're going to tell you about the principal and the interest. So over here, this is a sample mortgage statement. Let's say this person owes $345,000 more or less on their house. This is how much left they still have to pay off on their house. So they're going to see that. And the interest rate is also there. The maturity date, this person, if it's a 30-year fixed loan, must have bought their home in 2017, right? 30 years before this date. And down here, here's a little bit more of a breakdown. You can see of the amount that they have to pay for their mortgage. Like this is their monthly payment right here. $2,266 is what they owe. at the end of the month. How much of that is going towards principal and how much of that's going towards interest and this other thing called escrow. We'll talk about that in a minute. So of this amount right here, only $584 are actually going to principal, which means after they pay this, this number, outstanding principal balance, will only go down by like 600 bucks, more or less. $1,114 of this amount is going towards interest. So of this person's monthly payment, most of it is still going towards interest. And this is a process called amortization. Amortization is the ratio of principal to interest. And there's a thing called an amortization schedule. Basically, here's how this works. When you first buy a house, when you have a monthly payment, because clearly, like we said, this person is towards the beginning of their term, most of your monthly payment is going to go towards interest. Only a little bit's going to go towards principal. It's going to be very tough to pay down your principal early on in the loan. But as the loan progresses, the ratio shifts, meaning the interest amount gets smaller and the principal amount gets bigger every single month, usually just by a few dollars. And by the end of the loan, as we get into the 2040s here for this person, their interest payment is going to be very, very small, and their principal payment is going to be huge. So that's how amortization works. At first, most of your payment goes towards interest, only a little towards principal, and over time, the ratio shifts, and most of your payment goes towards principal and just a little bit towards interest. So there's that. Also, you can do what's called principal prepayment. Let's say you have some extra money sitting around, you want to pay off some extra principal, you can do that. You can prepay your mortgage principal. So if you want to bring down this big number right here and you've got some extra money sitting around with nothing to do with it, you can go ahead and do that because the longer, again, you owe this money, you're paying interest on it the entire time. So some people prepay their prepay their principal in order to save some money on interest. Now, there's this other thing called an escrow account. This is actually pretty nice. An escrow account is basically this account that your mortgage company sets up for you that is used to pay off some expenses associated with owning a home. And the reason why it's awesome is because when you pay your monthly mortgage payment, money just goes into your escrow account and then they use that money to pay off all these other things that you have to pay off anyway, but they do it for you. It's not your problem. So some of the things that you have to pay when you own a house is what's called private mortgage insurance. Not for the entire life of your loan, but if you are borrowing money to buy a house, you are presenting a risk to a bank, and they want to make up for that risk by charging you fees. And essentially, I don't want to get too much into this, but you'll pay what are called mortgage insurance premiums. Um, that gets paid out of your escrow account, so you don't have to deal with that. It's pretty nice. Homeowners insurance. When you own a house, there's always a risk that something could happen to your house. So you'll want to have homeowners insurance through a company like State Farm, but it's not free. You have to pay for homeowners insurance. That's something that gets paid out of your escrow account. And taxes. Some taxes you will have to pay out of pocket, like from your own bank account, but a lot of the big taxes like property taxes and school taxes also get paid out of your escrow account. So again, you won't even really notice it. You'll just pay your monthly payment. The bank will shuffle some of that money into this escrow account, and then when these things all come due, they just get paid out of the escrow account. You don't have to worry about it. It's not your problem. If you don't have a mortgage anymore, let's say you paid off your house, then obviously you wouldn't have to worry about this, right? You won't have that because you don't have a mortgage. But after you paid off your mortgage, you'll still have homeowners insurance you have to pay. Then you'll have to pay those out of pocket and remember to pay them. And taxes, you'll still owe taxes, so you'll have to remember to pay those too. But while you do have a mortgage, an escrow account is a nice, easy way to make sure that you are paying these things. Now, what happens if you're late or missing a payment on your mortgage? Well, fees will probably apply even for late payments. So try to pay your mortgage on time whenever humanly possible. And if you don't pay for long enough, this can lead to eviction. If they evict you from your house, that means they are taking your house away from you and kicking you out. Bad situation to be in. So, this is a little bit about how mortgage payments work. Again, some of your money will go towards paying down the principal that you owe. A bunch of it will go towards paying interest on your house. Some of it will go into an escrow account, which is then used to pay some other things like taxes and insurance. And every month you'll have this payment right here. Will this ever change? It can change, right? These two things are basically fixed if you have a fixed loan. But sometimes, let's say your taxes go up or down, or the cost of insurance goes up or down, that can increase or decrease your monthly payment too. Not by massive amounts, but you do have to, again, watch out for that. Typically speaking, one of the old rules is you shouldn't, like, your dwelling where you live, whether it's rent or whether it's a mortgage, shouldn't take up more than like a third, some people even say a half of your monthly budget. So you have to consider all these things when you're shopping around for a house. All right, well, in summary, good planning can make a huge difference, right? You have to, know remotely what you're going to do, right? Sometimes things change, you have to be adaptable, but good planning can make a huge difference in your life. Learn the rules of lending very carefully. The government makes these banks and everybody post all of these rules publicly. They're not always super clear. Sometimes they use a lot of like jargon, economic bank language, but there's a lot of great resources out there online. So learn the rules, do your research specifically before buying a car, applying to college, buying a house, and never buy anything that your income can't support, right? Just because there's a big fancy car you want, don't buy it if you can't afford it. Just because you want to go to this college, don't go there if you can't afford it. Also consider how much you're going to make, right? If you're going to an expensive college with a major that's not going to earn you very much money in your life, that might not be a good decision. And if you're buying a house, again, just because you want it and just because your friends are doing this or people you know are pressuring you to do that, never buy something that your income can't support. So that's an overview of some different types of credit. Thank you for watching.